Welcome to our High Rock video for March. I'm Scott Tomlinson, and with me on the call today is our portfolio manager, Paul Tepsich, who founded High Rock back in 2010. If you're interested in learning more about us, visit our website at www.highrockcapital.ca. All right, Paul, let's talk a little bit about February. February in Ontario was a month with not very much snow, unfortunately. So for the skiers, that is. But in markets, it was a month for equities, U.S. and global equities, driving balanced portfolios higher. Nothing for preferred shares, really. It was a quiet month for both them and for the bond markets. And of course, Canadian REITs still struggling, probably more from a lack of commercial rental space or commercial rentals than anything else. Paul, any comments on REITs?
Well, it's one of the reasons why we have not been invested in those. And geez, Scott, probably since like 2016, 17, maybe. And a host of a couple other reasons, but yeah, I was, again, you'll probably talk about it in another slide or two, just how bifurcated the market has become with some U.S. equities, even versus global equities.
Yeah, absolutely. Anything we want to talk about on our high yield mandates or preferred mandate? And obviously, as I said, preferred shares didn't do a whole lot in the month of February, so I guess it was a bit of a taking a breath.
Yeah, there was on the preferred share side within special mandates, there was a bit of a breath being taken. I would qualify that and say, like, we started that mandate in early mid-November, and we did not get the bottom, which was in October, unfortunately, because people were just getting accounts open and money in. Nonetheless, it's been a phenomenal start to the mandate, and I will talk about it in the fixed income model, but we did adjust things a little bit more in moving more into banks, and rather complicated, but the way banks are capitalized and their regulatory capital, I think they're going to be, most banks anyway, will be calling a lot of the preferred shares on their reset dates. So they either retract them, redeem them, or they have to reset them again for another 5 years. And we think they're going to be doing a lot of redemptions. So we've positioned that portfolio a little bit, well, quite a bit more heavily weighted towards certain banks and certain prefs. High yield, pretty much flat on the month. And as we mentioned to those investors that are in that mandate, we think this year is going to be a little bit more of a interest income, or what we call a coupon year, which is nothing to sneeze at when you've got yields up at 7% still in much of that paper. So we're still pretty positive in that area, and we've got a couple positions that could provide some capital gains as well. So,
Excellent. Always, as we remind our clients, that we're focused on the long term. And interestingly enough, we look at the Morningstar, the fund rating agency, that tells us that in over 1,000 funds and ETFs, the average global balanced fund over 10 years has returned just a little under 5%. So, and that includes a pretty significant down year for most balanced funds, somewhere in the vicinity of 10 to 12% in 2022. So that's something that we keep an eye on. But of course, we are focused on the long term and how that will impact our clients' financial goals as they move forward. Let's quickly talk about the Bank of Canada. Today, they decided to hold their policy rate at 5%. They're still keeping an eye on inflation, especially the core inflation. And at this point in time, they are hoping that that inflation will start to slow. Paul, we have seen CPI down to 2.9% at the latest reading, and that was for January. Interest rates still holding the policy rate at 5%. So it's an interesting story. Now, one thing that we can look at is that over the last 10 years, that average annual CPI rate has been at about 2.4%. And if you think back, that 10-year Morningstar Balance Fund was about 2.5% ahead of that inflation number. So still investing has over the long term continued to keep money growing at rates better than inflation, which can't really be said for things like GICs, right?
It's true for sure. And GICs are usually not liquid, and you're locked in, and you have no potential for capital appreciation at all. You get what you get on day
Although,
one.
yeah, and although there has been some focus on GICs with interest rates having moved up somewhat over the past couple of years, but
But
in the
again,
long term, yeah.
Yeah, sorry, I was going to say, you still, whether it's at 5% or whatever, you're putting it in for 2 years or 3 years, you're locked in. Number one, no liquidity. Number two, you have no chance for capital appreciation. I think we talked about this in maybe November, December, when government bond yields went down so dramatically, and conversely, the price went up so dramatically that it was an enormous percentage gain in those government bond yields. So you do have the prospect for capital appreciation, especially when they're priced below par. Better after-tax capital gain as well, and they're liquid. So I do caution people on at this stage looking at GICs, but I think that was a good trade maybe a year ago, not so much now.
So that's on the wealth side of things. On the debt side of things, it is estimated that in 2024 and 2025, 2.2 million Canadian households will be facing an increase in interest rates for their mortgages. There are approximately 45% of all outstanding mortgages due over this period of time. And that's a pretty interesting number. And that dollar amount of mortgage loans to be renewed is about $675 billion. And that's all according to the Canada Mortgage and Housing Corporation. So the household debt factor is certainly coming into play in the economy, Paul.
It's got to be, and I think that's one of the reasons why the Bank of Canada has got to close that gap. If inflation continues to drop like that, with mortgage refi coming up like that, it could, if they don't move quickly enough, that could leave Canada in a horrible situation. And you can look at even yesterday, I think the Parliamentary Budget Office came out and said the federal deficit's going to be $47 billion, which is a stimulus to the overall economy. But reading through the lines, the reason why that deficit is also going up so high is because of the debt servicing costs that the federal government now finds themselves in, being forced to pay a large portion of the revenue going out in the form of interest expense. It's a killer. So it's going to hurt it's hurting our provincial and federal governments, and it's going to hurt the consumer.
Absolutely. And at some point in time, that debt burden needs to be reduced, and that is going to hurt the taxpayer.
Yeah, indeed.
All right, let's talk a little bit about what's going on south of the border, because also today, Federal Reserve Chair Jerome Powell was reporting to Congress and basically saying similar things that they're going to keep an eye on inflation and wait until they get inflation under control before they start lowering interest rates. And having a look there, the latest CPI data shows inflation increasing over the last year at 3.1%. Interest rates slightly higher than in the US in the overnight space than in Canada and throughout the yield curve. Doesn't seem to be slowing the US economy significantly. And as we talked about, there's other aspects of the US economy that are continuing to do reasonably well, right?
Yeah, and we were talking about the industrial military complex. We've got massive manufacturing to replace weaponry that's being shipped over to certainly to the Ukraine, and if not to Israel. That's a huge boost to the economy. But the other thing too, we were talking about, Scott, is back to the Canadian slide versus the US slide as well. We've got both countries in the same situation where they're putting through a ton of fiscal stimulus by running these massive federal deficits, and in some cases provincial and state. And then you've got both central banks, which this chart shows quite clearly, are trying to run monetary policy, or are running monetary policy in a restrictive state. So the two forces are at odds with each other. I think if these federal governments could get closer to a balanced budget, we'd have interest rates back down towards that blue line.
Yeah, that's a very interesting concept.
And the only reason why we will get it back down to the blue line is probably because of economic weakness. And that may happen.
I think it's inevitable, but we'll see. All right, quickly, global equity strategy. As we rebalance, we are rebalancing out of equities because they have improved considerably. And our strategy at the moment is to take sales and take profits in the equity market because we think the equity market is overreaching. And as we've talked about in the past, it is a function of very few stocks leading the market. And this is just a great example over the last 2 years, basically a little longer. Really, it's been a couple of companies charging forward that have driven the S&P, and the S&P is only up 8% over that period of time. So that's approximately 4% per year since the highs of 2022. We're just over that now, but stocks that used to lead, like Amazon and Apple, are actually underperforming the S&P. So that's another interesting circumstance. And the Russell 2000, of course, being smaller companies on a broader scale, still not back to where they were in 2022. Paul, I don't know if you've got any comments on this.
No, not really. And you've got it in the title. It is kind of bad breadth. And, you probably read talking heads talking about how, this could be the blow off to the top side with what's going on with NVIDIA, et cetera. But yeah, it's quite incredible.
Yeah. All right.
Else.
Let's talk about tactical model strategy.
Yeah, the tactical model didn't really have any changes in it. We didn't do any buys or sells across the month. We still have a few high yield / they were distressed or more torquey corporate bonds in there. And I don't think they're really torquey anymore. They've come to fruition. I think we probably mentioned it last call, but like one of our biggest tactical positions now is Source Energy, which is a sand fracker. And, those bonds, we ended up buying it probably an average for most balance mandates at 45 cents in the dollar are now up at 95 cents in the dollar bid. And that is with an enormous coupon and cash yield on it. So we've more than tripled our money over the last couple of years on this position. and it's now been very stable. And there's a few others that are not quite as spectacular from a capital gains perspective, but they're very stable interest income for us. So no other trades there, and nothing, nothing else to really highlight, Scott. We can move to fixed income, which we did have. I wouldn't call it a trade, but a change. We had within the fixed income high yield component, which we see there in gray. We did have one bond, Cineplex, which I'm sure every listener is aware of. They called or repurchased the entire amount of this bond by issuing another new bond. So we got taken out of our 7.5 2026 bond, and we ended up able to buy, well, it took us two purchases, a 7 5/8 2029 Cineplex bond, same credit rating, same indenture in terms, etc. So we really just replaced one and went out another 3 years. And that worked out pretty well. We were able to buy at par, and we had to buy some more at 1 and 1.5 to get exactly what we needed for all of our clients. But they are bid there at 1 and 1.5, so that worked out pretty well. The only other thing to add, and I'm going into early March, just a few days ago, as I mentioned in the preferred shares, the preferred share mandate that we have, specific mandate, we've taken up a pretty big weight now in certain bank preferred shares that we think will be called or redeemed or purchased from us at $25, which is the par value on these listed preferred shares. And, we did this back in November, I believe, Scott, with a TD Bank preferred share, which we bought around $18.50. It's now trading up at $23.50. We think it'll be called in July. They typically are required to make that announcement, whether they're going to extend it for 5 years or redeem it at par 30 days in advance. So we'll know that in May, just in 2 months' time or so. Or pardon me, in June, so in 3 months' time. And then we think quite strongly that will be called. TD is in a surplus regulatory capital position, without going into a lot of complicated details of regulatory capital. And the other one we just bought a couple of days ago to add to that position is in the Bank of Montreal preferred share, which is a W as in windy. Same thing, they're in a capital surplus position, and we think they will call that one. And that one is not callable or redeemable until November, I believe. So once we get our TD one called, we'll own the BMO one, and I think it'll probably get called too. I think all of these banks, Royal Bank has to raise a bit more capital to call, but these other ones are in surplus positions, and they're going to just call these preferreds. They just won't exist, and a huge portion of the preferred share market will evaporate, certainly over the next 5 years. So we are in a overweight position in preferred shares right now, by roughly 5%. And I just want to let people know there is some method to that madness, and we're comfortable with that slight overweight position. That's it.
That's great. Thank you. And that's excellent insight. I appreciate you getting into that kind of depth. Okay, it's been RSP season. It's over, but for those who contributed late and close to the deadline, of course, there's always a few of those. You can expect your receipts in a couple of weeks. So that's just some update there for you. Again, here is the tax receipts schedule. We're pretty much into the waiting for the March releases of any receipts that you should get, which for the most part are Canadian trusts. So because we utilize Manulife's high interest savings account fund for our cash balances, there will be likely you'll receive those if you've not already received them, but the deadline for that is the end of March. So wait till you have all your T3s in before you file, because if you file without those, then you'll have to go back to your accountant and refile once you get them. So that's nobody wants to have to do that. Yeah, that's basically it. It is tax time. If you need any assistance getting receipts, please don't hesitate to get in touch. We are always happy to assist. They are available on the Raymond James website. If you need to update your password to get in, let us know. Or if you need our assistance in any way to get those receipts, please get in touch. And that's it. As always, we want to thank you for taking the time out of your busy schedules to tune in. We will be back with our next update at the beginning of April. So for those of you who celebrate, happy Easter. And on behalf of Paul and Diane, I'm Scott Tomlinson, and wishing you all a great month.